Preferred shares can be cumulative or non-cumulative in relation to the treatment of any unpaid dividends. For cumulative preferred stock, if the company doesn't pay the preferred dividends in a year or more, any unpaid dividends must be accumulated and paid to preferred shareholders before any payments are made to common shareholders. For example, suppose a firm has cumulative preferred shares that pay an annual dividend of $5 per share. Last year, it decided to omit dividends after a sharp drop in performance. This year, the company decides to distribute dividends to all shareholders. Before making any payments to common shareholders, it must pay a dividend of $10 per preferred share, accounting for last year's and this year's dividends. On the other hand, for non-cumulative preferred shares, only current dividends must be paid to preferred shareholders first. Therefore, there is no need to pay any omitted dividends. Referring back to our previous example, if the shares were non-cumulative, the company would only have to pay this year's dividends of $5 per preferred share. Preferred shares can also be participating or non-participating. Non-participating preference shares receive their predetermined dividends and par values regardless of the company's level of profits. However, participating preference shares receive extra dividends if the firm generates additional profits on top of a pre-specified level and may receive an amount larger than their face value in case the firm is liquidated. They are sometimes used by small firms, which have a higher probability of liquidation and are perceived by investors as riskier. Preferred shares can also be convertible. Convertible preferred shares are preferred shares that can be converted into common stock at a predetermined conversion ratio. For example, suppose an investor purchases 50 convertible preferred shares on the 1st of December, and each share can be converted into 2 shares of common stock. In this case, the conversion ratio is 2, or the number of common shares that the preferred share can be converted to. Convertible preferred shares have the following advantages. They benefit from the preferred dividend, which is higher than the common dividend. Investors can participate in the firm profits when they convert the shares to common stock. As the common shares value increases, the conversion option increases in value. Preferred shares are less risky than common shares as they have seniority in claims on assets and income in addition to providing a steady stream of income. Because of their advantages, convertible preferred shares are popular financing options for higher-risk companies, such as private equity firms. They are also being used by private firms, whereby investors benefit from the high dividends and the potential to convert their shares if the firm goes public. Find the full common and preferred equity video on www.cognivisio.com.